Every headline is screaming about a crisis in the Strait of Hormuz. With Iran threatening passage, the world is focused on oil prices, and some analysts are warning that Brent crude could be pushed toward $100 a barrel if the disruption is prolonged. But they might be missing the real story. This isn't just a potential oil crisis. It could be a strategic flashpoint for the industrial world's most critical metal. While everyone's watching the price of gas, a handful of investors are looking at 5 supply chain dominoes that could be about to fall, potentially, launching silver to an unprecedented $90. Let's break them down. Before we get into it, I want to be clear, I don't sell courses or memberships. My goal here is to share analysis, give you the data from both sides, and let you make your own decisions. I'm just here to connect the dots on complex events so you can see the bigger picture. First, let's get the facts on the ground. The Strait of Hormuz is the aorta of the global energy economy. About 20% of the world's petroleum passes through this narrow channel. Following recent military escalations, commercial shipping has been thrown into chaos. While it's not a formal physical blockade, the situation is a logistical nightmare. Iran's Islamic Revolutionary Guard Corps has issued warnings to vessels, and insurers are pulling war risk coverage, creating what is effectively a financial blockade. This has created a no-go zone for most major carriers. As a result, tanker traffic has plummeted by as much as 90%. Many companies have suspended transits or are weighing the long, expensive journey around Africa, which can add weeks and millions in costs to a voyage. The mainstream media correctly sees this as a threat to oil supply and a driver of inflation. Where they stop short is in understanding the second and third order effects. This crisis extends far beyond oil. It's a crisis for anything that moves by sea and for any industry that relies on energy, which is every industry. But one metal is uniquely exposed. A metal whose market was already showing signs of a breaking point before the first shots were fired. That metal is silver. Now, let's get to the 5 reasons this crisis could be silver's launchpad. The first domino is the most direct, the soaring cost of energy. The price of oil is a master input cost for the global economy, and the mining sector is one of the most energy-intensive industries on the planet. Here's the mechanism the market seems to be ignoring. Roughly 70% of the world's newly mined silver is a byproduct of mining for other metals, mainly copper, lead, and zinc. These are massive operations that run on an astonishing amount of diesel fuel. When the price of oil surges, the all-in sustaining cost, AISC, to produce every ounce of silver can explode. Let's put some numbers on this. Before this crisis, the AISC for many primary silver miners was already in the range of $18 to $24 per ounce. A huge chunk of that is energy. When crude oil prices jump, that energy component can rise dramatically. Some analysts calculate that a sudden energy shock could push the break-even cost for some primary silver operations towards $45 or $50 per ounce. This creates a brutal economic choice for mining CEOs. They don't run charities. They won't operate at a loss just to supply banks with cheap metal. As their costs skyrocket, they face a choice. Either sell their product for a razor-thin margin or simply hold back their inventory until the price on exchanges like the COMEX reflects the new reality of higher energy costs. This isn't just speculation, it's economic necessity. This threatens to reset the physical floor price of silver in real time. The paper market, which trades futures and ETFs, can ignore reality for a while, but it can't ignore it forever. You can't deliver physical silver that was never mined because it was too expensive to pull from the ground. The energy shock from the Hormuz crisis acts as a direct hammer to global mining output, squeezing an already tight supply at its very source. The second domino is the potential paralysis of the global high-tech manufacturing supply chain, with the solar industry at its center. For the last decade, the story of silver has been a battle between its monetary value and its industrial demand. Today, the industrial side is dominating. The world is in a massive energy transition, and silver is the single most irreplaceable element in this shift. Its unmatched conductivity makes it essential for photovoltaic, PV, solar panels. Industrial demand for silver has been setting records, largely driven by the solar sector. For years, the Silver Institute has reported structural deficits, with demand consistently outstripping new supply. Now think about how a solar panel is made. It's a marvel of global logistics. The raw polysilicon, wafers, cells, and silver paste might all come from different continents. This just-in-time system is incredibly efficient, but also incredibly fragile. The Hormuz crisis throws a wrench into this whole machine. It's not just about oil tankers. The disruption hits container ships carrying components and refined metals. A container of silver paste stuck on a rerouted vessel is a container that doesn't arrive at a solar panel factory. That factory can't produce, creating a backlog that ripples through the entire renewable energy pipeline. This logistical breakdown is compounded by rising costs from fuel and insurance. Adding to the tension, both the US and China have made strategic moves regarding key minerals. Recognizing its growing importance for technology and energy, the United States officially added silver to its list of critical minerals in late 2025. Meanwhile, China, which dominates the refined silver market, implemented new export controls at the beginning of 2026, creating a licensing system that could be used to manage its domestic supply. The Hormuz crisis, therefore, isn't just a temporary shipping problem. It's a direct blow to the world's green energy ambitions, and it targets the most critical and supply-constrained input, silver. The third domino is one that almost no one is talking about, a potential freeze in the supply chain for our most advanced technologies, especially AI hardware. If the solar industry is the broad base of industrial demand, the AI sector is the high-value, mission-critical demand where cost is secondary to performance. Every AI server, data center, and advanced semiconductor relies on silver. Its unique properties are essential for high-frequency data, thermal management, and long-term reliability. As the world stampedes into the AI revolution, the demand for the physical infrastructure to power it is exploding. This is where the Hormuz crisis could deliver a crippling 1-2 punch. First, the direct logistical impact. Just like with solar panels, the components for AI hardware are sourced from a complex global web. The disruption at Hormuz and the cascading delays at ports worldwide mean that critical components for building out AI infrastructure now face potential transit delays and rising costs. This throttles the physical build-out of the very technology that's supposed to drive future growth. The second punch is more subtle, the inflation shock. Advanced manufacturing facilities for semiconductors are incredibly energy intensive. Rising energy prices, driven by the oil shock from Hormuz, directly increase the cost of making these components. What makes this so potent for silver is that this demand is inelastic. A company building a multi-billion-dollar AI data center won't stop because the price of silver doubles. The amount of silver in each component is small, but its function is absolutely critical. There is no substitute. They will pay the price. This could create a scenario where a vital corner of the industrial world starts frantically bidding for a suddenly scarce resource. The fourth domino is the classic human reaction to crisis, the flight to safety. But this time, the stampede into precious metals might be different. Silver could be poised to outperform gold because it offers a unique double beta exposure to this specific crisis. Here's what I mean. When a major geopolitical event erupts, capital instinctively flows into safe haven assets like gold and silver. This is the monetary hedge against war and uncertainty. Gold is the king of this trade. However, the Hormuz crisis is also an inflationary event. By disrupting the world's oil supply, it sends a shockwave of cost increases through the entire economy. This is the second reason investors buy precious metals, to protect their purchasing power. Here's where silver's unique character comes into play. Gold benefits from the safe haven bid and the inflation hedge bid. Silver benefits from both of those. Plus, a third explosive catalyst, the industrial scarcity bid, which we've just covered. Think of it like this. An investor buying gold is betting that instability and inflation will make money less valuable. An investor buying silver is betting on that. Plus, they are betting that the very source of the instability, the Hormuz crisis, is simultaneously strangling the physical supply of a metal required to build our future. This is the double beta effect. Silver captures the monetary fear premium like gold, but it also captures the industrial panic premium. Its price could be driven by two powerful engines at once. This creates a powerful feedback loop. As industrial users pay more for physical delivery, it signals to investors that the paper price is too low. This encourages more investment, which tightens the market further, forcing industrial users to bid even higher. The fifth and final domino is the foundation for the whole thesis. The Hormuz crisis isn't creating a problem out of thin air. It's pouring gasoline on a fire that has been building for years. The silver market was already structurally strained before this crisis began. For years, global silver demand has systematically outstripped total supply from mining and recycling. This has led to a persistent market deficit, draining hundreds of millions of ounces from above-ground stockpiles. Think of global silver inventory as a reservoir. For half a decade, the outflow has been greater than the inflow, and the water level has been steadily dropping. We've seen signs of this tightness for months in the form of high premiums for physical metal and low inventory levels available for delivery at the COMEX. Now, into this already fragile system, the Hormuz crisis drops a bomb. It attacks the market from two sides at once. On the supply side, as we discussed, it raises the cost of mining, threatening to reduce the flow of new metal into the reservoir. On the logistics side, it blocks the pipes that deliver existing metal from that reservoir to the end users who desperately need it. This is a force multiplier. It takes a chronic slow burn deficit and threatens to turn it into an acute, full-blown shortage. The crisis could transform the market's problem from "we're using more than we produce" to "we can't get the metal we need at any price." This is the context that makes a $90 price target a logical, if speculative, possibility. The price of any asset is set at the margins. The Hormuz crisis is strangling supply, so the full burden of balancing the market falls on price. How high does the price have to go to force a manufacturer to shut down a production line? The answer is likely far higher than current levels. Now, to be balanced, no outcome is guaranteed. The path to $90 silver isn't a straight line, and a few things could derail this scenario. First is a rapid de-escalation. If the conflict resolves and shipping lanes in the Strait of Hormuz reopen, the risk premium could evaporate just as quickly. Logistical pressures would ease, and the immediate catalyst would fade. Second is the risk of a deep global recession. A sustained inflationary shock from higher energy prices could tip the global economy into a downturn, crushing industrial demand for all commodities, including silver. Finally, there's the US dollar. In times of crisis, the dollar often acts as the ultimate safe haven. A significantly stronger dollar can be a headwind for silver, making it more expensive for buyers using other currencies. It's a tug of war between the safe haven bid for silver and the safe haven bid for the dollar. It's essential to watch these factors closely. The crisis in the Strait of Hormuz is more than just a headline. It's a multifaceted catalyst lighting a fire under a silver market that was already primed. The 5 dominoes are all lined up. 1. Soaring energy costs are squeezing miners, threatening new supply. 2. Shipping paralysis is choking the solar industry's critical supply chain. 3. The AI revolution is facing a potential supply freeze, forcing high-value users to secure metal at any cost. 4. Geopolitical fear and inflation are creating a double beta investment case for silver over gold. 5. And all of this is amplifying a pre-existing multi-year structural deficit that has drained global inventories. The crisis is the amplifier. The deficit is the vulnerability. Together, they could create the conditions for a historic repricing of silver, potentially pushing it past the $90 mark. If you want to stay ahead of these events, make sure you subscribe and hit the bell for notifications. You won't want to miss what comes next. As this unfolds, keep your eyes on the key indicators: the physical premiums for silver, inventory levels at the COMEX, and insurance rates for tankers. They'll tell the real story long before the headlines do.